Hey there, deep divers. So it sounds like you're looking into covered call ETFs. I get the appeal. Who wouldn't want a shot at stable income from their investments, especially with how the market's been lately? We've got a mountain of articles here fresh off the press, and we're going to break down everything you need to know. What's driving the craze in South Korea, the pros and cons, and why even regulators are getting involved. It's a lot to unpack, but don't worry, that's what we're here for.
What's really striking is just how much these covered call ETFs have blown up in South Korea. We're talking about the ones based on the KO-SPI 200 index, and their value has almost doubled since last year. It's outpacing even the hottest sectors like shipbuilding and defense.
Yeah, we saw those numbers. It's pretty mind-boggling, but it makes you wonder why South Korea specifically. What's fueling this massive growth?
Well, there are a few things at play. First, you've got the South Korean government encouraging retail investment to boost the economy. And then there's the tax advantage that's unique to these ETFs in South Korea.
Okay, let's talk taxes. These ETFs are generating income through something called option premiums, right? And in South Korea, those premiums are tax-free. I mean, that's huge, especially compared to regular dividends, which get taxed.
It's a massive incentive for sure. To give you some perspective, imagine you have $100,000 invested. Those tax-free premiums could potentially net you over $10,000 in income each year, tax-free. No wonder people are flocking to these ETFs.
Wow, that's serious money. But it can't all be sunshine and rainbows, right? There's got to be a catch somewhere. The articles we have all seem to mention a limited upside.
You're right, there are trade-offs. The catch with covered call ETFs is that they limit your potential gains if the market suddenly takes off. To understand why, we need to dive a little deeper into how these ETFs actually work. They generate that income by selling something called call options, which basically caps your profit potential.
So if the market booms and the underlying stocks in the ETF skyrocket, you might not see those gains reflected in your ETF's value.
Exactly. You're essentially trading some of that potential upside for the consistent income from those option premiums. Think of it like putting a ceiling on your profits in exchange for a more stable income stream.
Ah, okay, that makes sense. So it's like a balancing act between steady income and the possibility of missing out on those big market jumps. It's not a one-size-fits-all solution then.
Absolutely not. It really depends on your individual investment goals and risk tolerance. If you're looking for consistent income and are comfortable with potentially missing out on those massive gains, then a covered call ETF might be a good fit.
So more predictable returns, but maybe not shooting for the moon. And we're seeing this trend take off globally, not just in South Korea. I guess investors everywhere are hungry for some stability and yield in these uncertain times.
You hit the nail on the head. When volatility is high and people are worried about their portfolios, strategies that offer some downside protection and consistent income become much more attractive.
Now, there's one thing in these articles that really jumped out at me, the whole issue with the names of these covered call ETFs. Some of them are confusing, to say the least. Even regulators are stepping in, which tells you something.
Yeah, it's a bit of a wild west out there when it comes to naming these things.
Yeah.
I mean, S&P 500 plus 10% premium. What does that even mean?
Right. It sounds more like a marketing gimmick than an actual investment strategy. And it seems like the Financial Supervisory Service in South Korea agrees. They're calling for clearer, more transparent names to protect investors from confusion and potentially bad decisions.
They're absolutely right to do so. Transparency is key, especially in a complex world like investing. Investors deserve to know exactly what they're buying and what the risks are, without having to decipher cryptic names or wade through technical jargon.
I totally agree. Imagine trying to pick a restaurant based on a menu written in a language you don't understand. It's a recipe for disaster. And that's what the FSS is trying to prevent in the investment world.
That's a great analogy. These names should be like those clear, easy-to-read nutrition labels on food packaging. You know exactly what you're getting into before you take a bite, or in this case, before you invest your hard-earned money.
Exactly. Now, I'm curious about something. These articles mention that younger investors, the 30 and 40-somethings, are getting into covered call ETFs, too. It's not just the retirees looking for steady income anymore. What's driving that trend, do you think?
That's a fascinating development, and I think it has a lot to do with the long-term potential of reinvesting those dividends. Young investors have time on their side, and if they consistently reinvest those option premiums, they could see significant growth over the long haul. It's like a snowball effect. Those reinvested dividends generate more dividends, and over time, those gains can really compound.
Yeah, the power of compounding. Time is your best friend when it comes to investing, and the earlier you start, the more that snowball can roll and grow. But wouldn't that also mean taking on more risk?
That's a key question, isn't it? How do you balance that desire for growth with the need to manage risk, especially for younger investors who might not be comfortable with wild market swings?
Yeah, that's a great point. It's not just about picking the right ETF. It's about developing a smart reinvestment strategy. Well, we've got a lot more to cover, so let's dive into part 2. All right, so we've established that covered call ETFs aren't just for income-hungry retirees anymore. But I think it's time we address the elephant in the room, the whole asymmetric risk-return thing the FSS is warning about. What does that even mean for someone who's just starting to explore these ETFs?
That's a smart question. It's all about understanding that while covered calls can offer some protection on the downside, there's still potential for loss. It's not a complete safety net. Think of it like this. You're betting on a horse race, but you've placed a side bet that limits your winnings. Even if your horse wins by a mile, you only collect a small predetermined amount. But if your horse loses, you still lose your entire bet.
Okay, so you're saying there's a limit to how much you can win, but not necessarily a limit to how much you can lose. That sounds a bit unnerving, especially for someone who's not a seasoned investor.
Exactly. It's crucial to remember that no investment is risk-free, even with strategies designed to mitigate risk like covered calls. There's always the possibility of losing money. It's about understanding those risks and making sure they align with your personal risk tolerance.
Got it. So it's not about avoiding risk altogether. It's about managing it intelligently. Now let's switch gears for a second and talk about how these covered call ETFs actually generate that income. We keep mentioning option premiums, but I think a lot of people might be scratching their heads wondering what those are.
It's easier to understand than you might think. Imagine you own a house and decide to rent it out. You, as the homeowner, collect rent payments from the tenant. In the world of covered call ETFs, you're the homeowner. Your stocks are the house, and the option premium is the rent payment. You're essentially giving someone else the right to buy your stocks at a certain price within a specific time frame.
So it's like I'm renting out my stocks, and the rent I collect is the option premium. And that premium is what gets paid out to me as a dividend in the ETF.
You got it. It's not that the underlying stocks themselves are paying dividends. It's the premiums from selling those call options that generate the income. That's where that consistent cash flow comes from.
That's a brilliant analogy. I think a lot of people can relate to that. Now, I'm guessing these option premiums aren't fixed, right? They fluctuate depending on a bunch of factors.
Absolutely. The price of those premiums is influenced by things like market volatility, interest rates, and the time remaining until the option expires. It's a dynamic market, and those premiums are constantly changing.
Okay, so there's a lot going on behind the scenes. No wonder those ETF names can get so confusing. And I bet it varies depending on which ETF you're looking at, right?
Right again. Not all covered call ETFs are created equal. Some focus on high dividend stocks, others might target specific sectors like technology or healthcare, and some ETFs might sell call options more aggressively, which can potentially lead to higher income, but also limit the upside even more. It's all about finding an ETF that aligns with your individual goals and risk tolerance.
So it's not a one-size-fits-all solution. You really need to do your homework and understand what's under the hood of each ETF before you invest.
Exactly. It's like buying a car. You wouldn't just pick the first shiny one you see on the lot. You'd research different models, compare features, consider your budget, and think about how you'll actually use the car. Investing in ETFs is no different. Take your time, research different options, and find the one that fits your needs.
Speaking of research, I think it's time to talk about taxes. We touched on how those option premiums are tax-free in South Korea, which is a huge draw for investors there. But what about the rest of the world?
That's a crucial point. The tax treatment of those option premiums can vary significantly depending on where you live. In some countries, they might be taxed as ordinary income, while in others, they might be considered qualified dividends, which are often taxed at a lower rate.
So it's not as simple as tax-free everywhere.
Not at all. And this is where seeking professional tax advice can be really valuable. A good tax advisor can help you navigate the complexities of the tax code in your jurisdiction and potentially even help you minimize your tax burden.
It's like having a knowledgeable guide to help you navigate the tax maze, right?
Exactly. They can help you avoid any unpleasant surprises come tax season.
All right, so we've covered a lot of ground. Risk management, the mechanics of option premiums, understanding the differences between ETFs, and the importance of considering the tax implications. But let's get back to those younger investors who are increasingly drawn to covered call ETFs. We talked about the power of compounding and the long-term growth potential. But what are some specific reinvestment strategies they should consider?
Well, as we mentioned earlier, I'm generally not a fan of market timing. Trying to predict when to buy and sell can be a fool's errand even for experienced investors. A much more reliable approach, especially for younger investors, is systematic reinvestment.
Okay, break that down for me. What exactly does systematic reinvestment mean in this context?
It simply means reinvesting your dividends as soon as you receive them consistently and without trying to outsmart the market. No need to overthink it or try to time the market perfectly. Just set it and forget it.
So it's like putting your investments on autopilot.
Exactly. It takes the emotion and guesswork out of the equation, allowing you to benefit from the power of compounding over the long haul.
And that consistency is key, right? Even if you're only reinvesting small amounts over time, those gains can add up significantly.
Absolutely. It's like building a house brick by brick. Each reinvested dividend is another brick in your financial foundation, and over time, that foundation becomes stronger and more resilient.
Love that analogy. So we've talked about the importance of understanding risk, doing your research, and developing a smart reinvestment strategy. But I think there's one more crucial element to consider, and that's the regulatory landscape. We mentioned the FSS in South Korea cracking down on those confusing ETF names. But what else are regulators doing to protect investors?
Well, regulators around the world are taking notice of the growing popularity of covered call ETFs and are stepping up their efforts to ensure transparency and investor protection.
Okay, that sounds promising. But what does that actually look like in practice?
In many jurisdictions, regulators are requiring ETF providers to be more transparent about the risks and potential downsides of covered call strategies. They're also working to ensure that marketing materials are clear and don't mislead investors.
So it's about making sure everyone is playing by the rules and that investors are getting accurate information to make informed decisions.
Exactly. It's about creating a level playing field and ensuring that investors have access to the information they need to navigate this complex world.
Well, we've covered a lot of ground in this part of the deep dive, but we've still got more to explore. Welcome back, deep divers. We're in the final stretch of our exploration into the world of covered call ETFs. It's been quite a journey, hasn't it? We've covered a lot of ground, but there's still so much to uncover.
It's fascinating how this investment strategy has captured the attention of both seasoned investors and those just starting out. And as we discussed, regulators are playing a crucial role in shaping this landscape, ensuring transparency and protecting investors.
Right. It's like they're building guardrails on a winding road, making sure everyone stays safe while still allowing for exciting possibilities. But let's shift gears for a moment and talk about something we haven't delved into yet. Specific examples of covered call ETFs. There are tons out there, each with its own unique flavor and approach.
Absolutely. Let's start with one we touched on earlier, the high dividend weekly fixed covered call ETF in South Korea. It's a prime example of how ETF providers are innovating to address investor concerns about limited upside potential. Remember how we talked about that balancing act between income and growth?
Yeah.
Well, this ETF tries to find a sweet spot.
Yeah, it tries to have its cake and eat it too. It focuses on high dividend stocks, so you've got that potential for income right off the bat. But it also limits the percentage of call options it sells, allowing more room for those underlying stocks to grow in value.
Precisely. It's like they're saying, we hear you investors, you want that consistent income, but you also don't want to miss out if the market takes off. It's a clever strategy, and it seems to be resonating with investors in South Korea.
Now let's hop across the globe for a second. We've been focusing a lot on South Korea, but these ETFs are gaining traction everywhere. One that's super popular in the US is the Global X NASDAQ 100 Covered Call ETF, ticker symbol QYLD. It tracks the NASDAQ 100, which, as you know, is packed with those high-flying tech giants.
The NASDAQ 100. A breeding ground for innovation and, let's be honest, some pretty wild market swings. But that's where the covered call strategy comes in. It aims to smooth out those bumps and provide some consistent income, even in a volatile sector like tech.
Exactly. It's like taking a wild stallion and putting a comfortable saddle on it. You still get that exhilarating ride, but with a bit more stability and control. But let's be real. Tech stocks aren't for the faint of heart, right?
You're telling me. But that's where diversification comes in. Don't put all your eggs in one basket, no matter how shiny or promising that basket might seem. Spread your investments across different sectors, different asset classes, maybe even different countries. Build a well-rounded portfolio that can weather those market storms.
So don't just bet on one horse in the race. Spread your bets and increase your chances of winning, or at least minimizing those losses. Speaking of minimizing losses, we've talked a lot about the risks and rewards of covered call ETFs, but what are some of the other things investors should consider before jumping in?
That's a great question. One thing that often gets overlooked is expense ratios. ETFs, like any investment, come with fees. Make sure you understand the expense ratio of any ETF you're considering. It can eat into your returns over time, so it's definitely worth paying attention to.
Yeah, those fees can sneak up on you like hidden charges on a phone bill. Another thing that's important is understanding the ETF's track record. Don't just blindly follow the hype or chase the latest hot ETF. Look at its historical performance, see how it's weathered different market conditions, and make sure it aligns with your long-term investment goals.
Exactly. It's like choosing a hiking trail. You wouldn't just set off on a random path without checking the map or knowing where you're going. Do your research, understand the terrain, and make sure the trail aligns with your fitness level and desired destination.
Love those analogies. They really paint a vivid picture. So as we wrap up this deep dive, what are some final nuggets of wisdom you'd like to leave our listeners with?
Well, I think the most important thing is to remember that knowledge is power, especially in the world of investing. Don't be afraid to ask questions, challenge assumptions, and do your due diligence. And most importantly, don't let fear or hype dictate your decisions. Make informed choices that align with your individual goals, risk tolerance, and time horizon.
Beautifully said. And never stop learning. The world of finance is constantly evolving, so stay curious, explore different perspectives, and keep refining your investment strategies. So deep divers, we've reached the end of our exploration into the world of covered call ETFs. We've navigated the twists and turns, explored the pros and cons, and hopefully equipped you with the knowledge to make informed decisions. Now here's something to think about. If covered call ETFs are all about balancing risk and reward, what are you most comfortable with giving up in pursuit of stable income? That's something only you can answer. Until next time, happy investing.